Okay. Thanks, everybody, for staying to listen to what I think is actually the most important panel of the day, because it's talking about how we unlock private capital for the development of digital infrastructure in Africa. I think funding is the critical piece of the puzzle to bridging the digital infrastructure gap in Africa. And the panelists that we have here on the stage and joining us online, I think are best placed to speak to the different challenges that the digital infrastructure asset class faces. So I'm just going to kick off the questioning with a question for all of the panelists to just kind of set the scene for the session. So I'll start with Shayo. And the question is, Africa needs an estimated 100 to 150 billion in digital infrastructure investment to close the digital infrastructure gap. From your perspective, what's the biggest barrier to financing? Is it risk perception, bankability of projects, or lack of local capital mobilization?
Yeah, no, it's a good starting question. I think, to be honest with you, I think all the things you've outlined are, barriers to entry for financing projects in Africa. Naturally, I think on the continent there is a lack of local capital. That local capital can help mitigate some of the FX concerns that international investors have. Perceived risk in Africa, I think we all know that Africa unfairly has sort of like an Africa risk premium from international investors. But for me, my opinion is the biggest barrier to entry is bankability. We have, as you said, $100 billion gap annually. So that obviously indicates there are numerous opportunities to have projects developed in Africa. But the reason why all of these projects generally fail is because of bankability. And bankability is caused by a lack of preparation. A lot of projects, when they come into the market, they tend to neglect the need to prepare their projects for bankability. And this is via various things, right? It's feasibility studies, getting your land, your permits, working with the right contractors. But most importantly, it's being able to understand the risks and being able to allocate the risks to the proper counterparts. It's one of the things that, as an infrastructure investor, any project that you are in contact with, ignoring all the fancy models and everything, it's really a case of, do you understand the risks associated to the project? Once you understand the risk, you can then allocate that risk and then have a bankable project. So for me, the short answer to your question is, undoubtedly, the highest barrier to entry is bankability.
Excellent. Thanks for that response. Uguche, let's come to you.
I think it's a bit of all of those. I think there is some perception of risk from the asset owners and the people that manage capital. There's also a bankability problem. There's also a just understanding problem. It's also an emerging asset class, right? It's not something that the local funders are typically used to. And I always say infrastructure is an emerging asset class, and thanks to what AFC is doing. But typically in Africa, trade finance is something that most financiers are used to. So this is an emerging asset class, and I think it's taking time to understand. I would say it behoves on both parties, those who are funding, those who are fundraising, to sort of come together and understand, what the dynamics are. Like you said, once the funders understand the risks, then they're able to allocate better. So I'd say it's not one thing. It's a bit of all of those: the bankability, the perception of the risk, the risk involved, the understanding of this asset class. And I think once the parties come together, we should begin to lower that perception of risk and get the funding to this digital infrastructure that is really needed in Africa.
Yeah, excellent. I love the nuanced perspective you've brought. Let's go to our panelists who are joining us online. We'll start with Vivek.
Thank you very much. Do you hear me clearly enough?
Yes, I can hear you.
Look, I mean, I think both Shayo and Uruche have dealt with the matter. But the reality is, I'll just add, you know, so what is bankability? First of all, I think it's worth having a chat. When I ask a lot of people this all the time, and most people say a project should be profitable, and that's fine. But there is another angle to bankability, which, you know, the profit in an infrastructure project is a mix of revenue, the cost of capital, and the cost of building it, right? I mean, so that maths is not very difficult. What is difficult is the risk allocation, the risk mitigation, the risk elimination. So if I was to go to AFC and say, look, I have this plan for a big AI data center, which will be $100 million. Here's the plan. They'll say, fantastic, come back when you've nailed down these 75 different risks. And those 75, I'm just taking a number. It's big. It's not a dozen risks. It's not 150 risks, but it is substantial. They require the input of many people. They require somebody who's going to build it, somebody who's going to supply the equipment, somebody who's going to, you know, debt and equity. There are 4 or 5 different government agencies. There are lots of lawyers. There's lots of different technical advisors and the such like. And that process of unwrapping all the risks, that is what is complex. That is what is new. Now, data centers have been being built in elsewhere in the world for a long time, but it's new to Africa. And that is where the challenge comes. Now, this ecosystem of people, institutions that need to come together to unbundle that risk, that requires practice. That's where the repetition is important. And, you know, if a project is going to take 5, 6, 7, 10 years to get off the ground, as energy sector projects do, oftentimes, then that practice never happens. So you know, I've gotten into the weeds on this, but just to add to what the 2 previous speakers have mentioned, that, you know, we should look at, so there is always a risk perception. People from afar will not know the difference between Lagos and Luanda, for example, or you know, Morocco or Madagascar. I mean, yeah, that perception is always there. But the more we have a practice of successful projects getting to financial close and then investors getting paid back, that will reduce over time. So hopefully that gives you a little bit of sense.
Yeah, thanks, Vivek. And let's wrap up on this opening question with a response from Ben. Ben, can we get your perspective?
Hello. If you could repeat the question, because I have just joined. I've just landed in OR Tambo. So if you could repeat the question, that would be superb.
Sure. So the question was, Africa needs an estimated $100 to $150 billion in digital infrastructure investment to close the digital infrastructure gap. From your perspective, what's the biggest barrier to financing? Is it risk perception, bankability of projects, or lack of local capital mobilization?
I think it's all of the above to some extent, right? I think that certainly local capital should be going more, particularly pension funds and other things. You look at globally, data centers are being funded by pension funds and REITs and other things, and that is not happening in every part of Africa. But even when it does, even when local banks are putting lending in, it's very expensive. Yeah, I mean it's almost too expensive to be doing infrastructure projects when you're borrowing at 17-18% from local banks. So it's a piece of that, but obviously, when it's come to digital infrastructure, it's largely been and DFI financing, which is, and I think I just caught the end what Vivek was saying, but projects and different types of ICT projects is that energy projects often the offtake is de-risked by long-term agreements where the offtaker will basically commit to taking all the capacity of an energy project. Where if you are building a data center, you tend to overbuild the capacity versus what the immediate customer needs are. So there is an element, you have to de-risk it with anchored customers, but there's still a large element of build it and they will come. So you're building much more capacity for the future growth. Whereas the energy sector, it's like turn on from day one, the PPA kicks in and your full capacity is sold. And then fiber, fiber infrastructure and mobile networks and other things. Technology is always increasing, so the speeds, the available capacity is getting more and more and more. So even as you get offtake customers at the beginning, you never sell the full offtake capacity of a subsea cable or terrestrial cable or any other types of last mile networks. Even building out fiber to buildings, you don't get full uptake. You don't get every customer, every single building and every customer connecting. So there's the element of risk, which is probably I say it's more risk, but the de-risking is less than for the energy projects which Vivek was just talking about. So a whole bunch of things that are holding things back, but that for me would be certainly one of the main factors. Yeah.
Excellent. Thanks, Ben. I really like all of the responses that I've gotten because I think what it's kind of showing is that question is a bit of a trick question, really. It's a many-faceted problem. So let's dive into some of the specifics now. Uguche, you didn't mention, or maybe you did, just in passing, the question around how to unlock local capital, of which there is a lot, actually, and you'll know this better than anyone. There's about 20 trillion plus under management by pension funds in Nigeria, and very little of that is being allocated to infrastructure. Even infrastructure as an asset class, not talk of digital infrastructure as a subset. So I want to ask you, what regulatory or structural changes do you think would unlock pension funds as a major source of patient capital for digital projects?
1% of that 24 trillion plus invested in infrastructure. And that's a miserly number, but I always say it's actually grown from 0% maybe 6-7 years ago. So there's some progress. In terms of regulatory levers, the regulator has done something recently over the last 2 weeks. They've released new investment guidelines, and I think that should see more investments in infrastructure. The challenge now is which infrastructure, because as a country and as a continent, we're infrastructure starved, whether it's road, whether it's power, whether it's transport, and whether it's digital infrastructure, right? So how do we prioritize? What I think needs to happen is that there needs to be sort of a grand vision from a country, continent point of view that we are prioritizing this. If we want to grow, we need to prioritize these levels of infrastructure, because when the funding is unlocked, it's now a case of who is bringing projects that have better returns, who is bringing projects that are quote unquote sexier in sectors that people understand more. So in terms of what levers the regulator can push, and I think they've begun to do that, and they do deserve a pat on the back. Number one is reducing the allocation to government securities. So pension funds have been accused in the past of, dumping in government securities and with little risk. So the allocation was before about 60%, and the regulator has reduced it to 40%. So what they're saying is that, you have to have a maximum cap of government securities. So if you reach this maximum cap, you now need to look for other asset classes. They've also increased allocation to infrastructure funds, infrastructure bonds, private equity. So that, I think, they should be commended. And this was just 2 weeks ago. So I think we'll begin to see the pass-through from that in the next couple of weeks, months. And for project sponsors and like AFC and the rest, is begin to engage with the pension funds to say, what do we need to do? How can we unlock this? In the sense that even though you're moving from government securities to real infrastructure, the risk profile shouldn't be, that outsized, so that, they're even scared to make those calls. So regulator has done some. I think it's now up to the market to begin to see how we can, jump on what the regulator has done.
Okay, thank you. Let me ask Vivek the next question, because it's flowing from the question I've just asked you, which is Nigeria specific. I want to ask the same question more or less, but from a continental context. So Vivek, how do you think other African markets can replicate pension-led financing models for data centers, fiber, and cloud infrastructure?
It's not a question of pension funds allocating funds specifically to data centers or fiber. Infrastructure has, if it's done right, has a long-term yielding nature. So there's a lot of predictability in the cash flows. But there are challenges, right? So I would look, there is not a lot of precedent on the continent, I'm afraid, not even in South Africa, where it has taken hold. So the risk, it's comparing a horse to a camel. Pension funds have access to capital market instruments, they can invest in shares or government securities that have quite a lot of liquidity. There are instruments that allow for liquidity in infrastructure. And it's taken a while, even in the US and UK and other developed markets, for that to take hold. It's a mindset issue, which was mentioned in the earlier panel over there. In Australia, in Canada, and Denmark, for example, pension funds have more or less abandoned government securities and treasuries in favor of long-term equity or hybrid equity debt instruments in infrastructure. That mindset takes a little bit of time. So if you look at it from a pension fund's point of view, they get a certain return at relatively no risk by giving money to the government compared to the local currency. And then they have to do all this analysis, and then Ben comes along and says your interest rate is too high, or your return requirement for infrastructure is too high. And all this risk is very difficult for the institutions to take on.
Ben, where do you see the best opportunities for public-private partnerships in digital infrastructure? And what lessons can be drawn from power and transport sectors?
Some background noise. Yeah. Sorry. Yeah, so I think, look, when people started building out, particularly fiber and subsea cables and data centers, they started building out all of these things. The first ones to get built were the lower-hanging fruit, right? What were the most commercially exciting routes of fiber, the most commercially exciting locations for data centers, and the subsea cables, most commercially exciting, were built out. But we haven't yet built all of those needed, right? So let's take West Africa, for example. There are a whole bunch of countries in West Africa that have only one subsea cable touching their shores. And that subsea cable as well, it's got a finite lifespan and might, become end of service in a few years. And I've been involved in looking at
Yeah.
some of these. When you look,
Yeah, Ben, I'm afraid we are struggling to hear you. Your connection seems unstable. I imagine you're dialing in from somewhere in Africa. Okay, Ben, we'll have to move on. The digital infrastructure gap strikes again. Let's move on to the next question. Our time is actually up, so I'm just going to move to closing remarks for Vivek, who I think is still with us, and Shayo and Oguche. Just give me in one sentence, what is the single most important step Africa must take to unlock the next $100 billion for digital infrastructure? Shayo.
I'll keep it easy for me. I'll keep it in the theme of the discussion I've been saying. The single most important thing that Africa must do is build bankable, scalable projects. We have a $100 billion gap annually. We're not going to plug that gap financing 100 projects a year. We're going to plug that gap financing several bankable projects that are scalable to meet future demand.
Excellent. Oguche.
I think it's really capacity building of the financiers. I think once the financiers understand the sector, are comfortable with the risks, and their de-risking mechanisms, then I think the financing to that sector will grow.
Okay, so de-risk. Vivek.
A single word is, to de-risking and bankability is revenue. We need clear paths to revenue for these projects. And there's a big distinction between projects that are able to demonstrate that, where the teams have a vision on how to create revenue. Build it and they'll come as a philosophy doesn't work. The intermediated philosophy of approach of signing long-term contracts with utilities that can't pay their bills and do not pay their bills, and then trying to enhance that credit price doesn't work. So single word, revenue.
Thank you, Vivek. And Ben, if you can hear us, your thoughts?
I can hear you, and sorry to have lost you just now, but I mean, perhaps to build on that, in order to get revenue, we have to have the basics of services working, right? And the fact that I can be in Africa's biggest and busiest airport and the Wi-Fi stops working for 30 seconds while I'm on a video call is a demonstration of some of the sorts of things. We have to really make sure that the services are working in order to make people want to use that Vivek is talking about. So, ultimately, whatever services we develop from having the digital infrastructure, they have to, be useful to people in whether they be businesses or citizens, and they have to work, and that has to be then become something that people will happily pay for. I mean, I wouldn't have paid for this Wi-Fi; I got it free, but I'm not very happy with the service.
Yeah, well said, Ben. Thank you. Okay, we will just try and wrap up with a few questions from the audience. So if there are any questions, can you just raise your hand? I think there's one in the back. We'll do it quickly. Yes, I know. Yeah, but we have.
Tell us your name and straight to your question. 1 minute.
Yeah, my name is Peter. So just the SOSIF fund for Africa Tech is already hard. So I don't know how AI and this new age, how we are going to tap into this. We are seeing companies raise billions and billions, and African tech companies are already struggling to even raise $1 million. So I don't know how we can work on that to improve on that, because we need this funding to grow our product and grow our tech. Thank you.
The guys on this panel are more infrastructure focused. Not sure
We can try.
we have the capacity, but
We'll try.
Shia will try.
We'll try. Look, I think it's a good question. One thing African entrepreneurs have to be able to focus on is building solutions to solve for African problems. I know the buzzword in Europe and the US right now is AI, and that's how, European or American companies are raising money. They're raising money on the back of AI. If you want to raise money for an e-commerce business in Europe now, it's not attractive. But if you say it's an AI e-commerce business, you raise 100 million. We don't have an AI issue now, so our founders need to focus on solving for African issues. And they've done that well, right? They've done that well in the fintech space, right? We've gone leaps and bounds in how we've solved for financial inclusion by solving for a very Africa-focused problem. We didn't try to solve for a problem in the US with our financial inclusion issues here. So it's a catch-22. I understand that right now, if you're trying to raise money abroad, they're kind of focused on AI. But I think ultimately our founders have to remain, strong and focused in what they're solving for. There is capital, coming into Africa to solve for those issues. They just need to be patient and look for the right partners who are willing to go with them along that journey. So, in a nutshell, you just have to find the right partner to be able to raise the capital.
Excellent. Thanks, Shia. I hope that answers your question. We've been told time is up and we have to wrap the session up. So I will just say a very big thank you to all of the panelists. And thank you to the audience as well for staying this long to hear them speak. Good afternoon, everyone.